Hey everyone, welcome back to Corporate Decoder, the place where we dive into the world of business filings so you don't have to. Today we're cracking open a Schedule 14A from Verisk Analytics, and let me tell you, it's not your grandma's recipe book, it's a proxy statement, which means we're talking shareholder meetings, board elections, and maybe a little corporate drama. Hold on to your hats. Verisk Analytics wants your vote. Specifically, they are asking for your approval on some key items at their annual meeting. This isn't just about rubber stamping decisions, it's about the future direction of the company. First, there's a letter from the independent chair, Bruce Hansen, talking about consistent growth and strategic engagement. He mentions Verisk delivered strong performance, is engaging clients, and is investing in innovation like AI, and a cool one-time $3 billion was returned to shareholders. The board is getting a makeover. 2 long-standing board members are retiring and 2 new independent directors are being nominated. Christopher Perry, with expertise in information services and sales, and Sabra Patil, a financial executive from the insurance world. Now let's get to what you as a shareholder get to vote on. The big one is electing 11 members to the board. You also get to weigh in on executive compensation, that's the say on pay vote, and ratify the appointment of Deloitte as the independent auditor. Here's where it gets interesting. There are proposals to eliminate supermajority voting standards for certain things like who can own the company and business combinations. Right now, these require a supermajority vote, basically a really high bar to pass. Verisk wants to lower that bar, making it easier to make these kinds of changes. They also want to limit the liability of officers as permitted by Delaware law and enable shareholders own 25% of the company to call special meetings. The board recommends voting for all the management proposals and against the shareholder proposal. More on that later. Time for a quick look at what else this proxy statement holds. We've got the usual suspects: corporate governance, director compensation, executive compensation, and a shareholder proposal. The board members have diverse experience from sectors like insurance, big data, finance, and global operations. Verisk wants individuals with strong decision-making and leadership skills. Getting to the nominees themselves, we see Bruce Hansen, the independent board chair who has a long history in data analytics. Christopher Perry is an IT big shot. Sabra Patil brings decades of experience in insurance and financial services. Lee Shavel is the current president and CEO of Verisk with a background in finance and corporate strategy. Olamide Soroy is the president and CEO of Intelligent Operating Solutions at Fortive. Kimberly Stevenson has spent her career in the technology industry, and Therese Vaughan has a deep understanding of the insurance industry and its regulations. Here are some of the corporate governance strengths: annual election of directors, proxy access for shareholders, a separate independent chair and CEO, a mandatory director retirement age of 75, and no poison pill. No hedging or pledging of company securities is permitted either. Verisk formed a new risk committee and continued board refreshment by nominating 2 new independent board candidates to stand for election at the 2025 annual meeting. 10 of the 11 current directors are independent. Lee Shavel, the current president and CEO, is not considered independent. There are 6 committees: executive, audit, talent management and compensation, finance and investment, governance, corporate sustainability, and nominating and risk committee. The audit committee reviews the company's financial controls and compliance. The talent management and compensation committee determines executive pay. The independent compensation consultant is called F.W. Cook. The board seeks individuals with diverse backgrounds to enhance its effectiveness. Risk oversight is handled by the board and various committees, including the new risk committee. The enterprise risk management team conducts annual risk assessments. Non-employee directors receive annual retainer plus an equity grant. The independent chair gets an additional retainer. Looking at director compensation for last year, Bruce Hansen, as independent chair, took home the biggest payout at $465,000, while most others averaged around $300K cash. Several of the top dogs already hold hundreds of thousands of dollars in stock too. Moving on to principal shareholders, we see the Vanguard Group owns 11.3% of the stock, while BlackRock owns 9%. Alright, the bit everyone waits for: executive compensation. It's important to remember that most senior employees get a large proportion of their total compensation at risk, so they can really win big, or not. Verisk had a strong year with revenue of $2.88 $8 billion, up 7.5%, and net income of $57.5 million, down 55.9%. Adjusted EBITDA was up nearly 10%. Adjusted EBITDA was up nearly 10%. Shareholder saw a 16% return. The CEO's total direct compensation was set at $12 million. Short-term incentives were tied to company performance, while long-term incentives included performance stock units, restricted stock, and stock options. The 2024 Say on Pay vote had 94% shareholder approval. In good news, they don't have time their equity grants around major company news, which is always good to hear. Looking at the 2024 summary compensation table, we can see Lee Shavel, the CEO, had total compensation of around $12 million. Elizabeth Mann, the CFO, came in around $4.5 million pay packages. Digging into the grants for different awards for 2024, we can see how the different performance tiers can play out. This table reveals all unexercised options and unvested stock held by Verisk's executives. For Lee Shavel, that meant as of the end of last year, in exercisable and unexercisable stock options, he was holding tens of thousands of shares. I personally like the idea that people in charge of a company have a direct interest to make it succeed. The company also details vesting of shares for the top NEOs. Here they describe a compensation plan, which is only available to high earners that effectively restores benefits they would otherwise be entitled to, but are capped by the IRS. There are stock ownership guidelines in place for executives. The CEO has to hold stock worth 6 times their salary. There's also a clawback policy which lets the company recoup compensation in case of misconduct. There is also a lot about IRS code. Verisk assesses the risks related to its compensation policies. This involves having an independent compensation consultant review the programs and their mechanics. Now, before we wrap up, a quick advisory. Verisk is asking you to approve the compensation of their named executive officers. The final items for 7 are requests for votes on proposals to make certain changes, mostly to the voting needed for certain actions, and also to limit liability of officers. The board is recommending a vote. Finally, there's a shareholder proposal to support shareholder ability to call for a special shareholder meeting, but the board is recommending against it. So what's the story here? On the surface, Verisk appears to be a company that's growing, profitable, and rewarding its shareholders. Executive compensation is high, but tied to performance. However, there are some things to consider. Is that stock ownership requirement high enough? Should there be more individual hurdles, as there appears to be a very good old boys club vibe to the awards? Overall, Verisk is going to need to show that it can continue to innovate and grow in a rapidly changing data and analytics landscape. It needs to keep its costs in check and maintain its strong financial position. It also needs to address the increasing concerns about its governance and make sure that it is acting in the best interests of all its shareholders. Thanks for watching. If you found this breakdown useful, hit that like button, leave a comment, and definitely subscribe for more corporate deep dives.